May 22nd, 2022. Nathan from Queens, Ultimate Traders. I'm going to hit you all with 3 different videos. This first video is about recession. A lot of people don't know what a recession actually is, what a recession means to the economy, what a recession means to our companies, and what a recession means to our stocks. So the first thing that I have to tell you is, I don't define a recession. A recession is 2 consecutive quarters of lower gross domestic product. So gross domestic product is overall sales of an economy. So in general, you like to have maybe 3 to 5% growth in the economy, GDP, and you want inflation at about 2%, and interest rates are normally also around 3 to 5%. Now, in the first quarter, we were expected to grow GDP at 1%. We actually had the decline of 1.4%. So we were actually already in 1 quarter already of lower gross domestic product. Chances are we've already hit the second quarter. We're going to have a recession. Now, whether or not we're going to be in a deep recession, I'm going to get into that. But right now, as it is, unfortunately, it looks like we're going to have 2 consecutive quarters of a decrease in gross domestic product, and we're going to have a recession. So the recession is like an indicator for an alert for us as traders, people looking at the economy, because it's an alert. Without an alert, there's no way for us to really gather or gauge what's going on with the economy. When we had GDP numbers go down, most new retail traders did not know much or know what that meant. But I kind of knew that, hey, if gross domestic product is dropping, 60 or 70% of our economy is the regular everyday consumer, not the rich people, the everyday consumer. I did a video months ago. If we have gas prices very high for 2 consecutive months, not 2 consecutive quarters, 2 consecutive months, more than likely we were going to hit a recession. I did that video a few months ago. Gas right now is hitting record highs. We're actually exporting oil to a lot of other countries, and it's making our oil price goes up. And if our oil prices go up, everyday consumers are not able to spend. And like I said, 60 or 70% of gross domestic product is the everyday consumer. So if the everyday consumer is getting pinched, we're going to have a recession. What does a recession mean to our companies? What does it mean to our stocks? So on top of insane inflation that we're getting right now, because we had trillions of dollars printed, money just thrown, stimulus thrown, people were given $1,000 a week to stay at home with unemployment. This is the aftermath of all that. And unfortunately, with really fast rising inflation, crime goes up. Crime goes up. Margins at companies, when they report earnings, the margins go down. Why? Because the cost of everything goes up. Little by little, they raise prices. When they raise prices, people aren't able to have the same spending power. Crime goes even more up because what do we know? People want to live. People don't want to pass away. I don't blame them. And they seek other means to be able to buy the same or to live. You can't blame them. But when that happens, all the companies, like all the retailers, get hit. Now, we saw that with Amazon. We see that with Target. We see that with Walmart. We saw that with Lowe's. Home Depot, I'm actually a little bit impressed. We saw that with Ross stores, but it's a trickle down thing. So little by little, all the other companies and a lot of the other companies are getting pinched. The margins are getting pinched, and people aren't able to spend the same. What's terrible about a recession also is not just for the market, and the only way to fight inflation is to increase interest rates. When interest rates rise, the cost of money becomes more and more expensive. Unfortunately, it's the American way to borrow a lot of money. Even if you have $1 billion company, it's the American way to borrow a lot of money. And when they borrow that money, they use it to hire people to buy other companies. When the stock goes up, they sell shares to raise money. Guess what happens when the stock goes down and the cost to borrow is more? They start laying people off. They can't raise money by selling shares. In January, Boeing was close to $220, $230. I did a video. I did multiple videos on Boeing when it was in the 200s, how bad their financials are, and what's going to happen to them when the rates go up. The problem is when the stock was high, they should have shafted retail, because now the price is $120, interest rates are high. What is the likelihood of them getting new bonds at a lower rate? What's going to happen to the stock now? I think it's 120, it's down 50% if they try to sell shares. It's going to go even lower. They were better off raising money when the stock was high. And the main thing about a recession, because like I already told you, in a recession, rates are going to go up. Liquidity is tough, meaning any company that does not make money, I don't care what company it is, if your company does not make money, the cost for them to borrow new money goes up. Since the stocks are down, and if they have to stay in business, they're still going to sell shares. So GameStop, months ago, it was almost $200. The company said they're going to, I don't know why, because they already had authorization to do 300 million shares, and they have about 80 million, but they wanted to do a split. Now the stock is like at 90. Let's see if they split. But the split wasn't just to split the stock. When they split, they're going to release brand new shares into retail on top of the split. It's going to be tougher in this environment. So not just for GameStop, for Ader, for BBig, for any company, even Carvana a few weeks ago, after earnings, they try to raise money, selling shares, and getting new bonds that were junk status at 11, 12%. So what does that mean? That means that it is very, very risky to buy any growth stock. Growth stocks generally do not make money. They grow, but they lose money. When they lose money, they have to go and get new loans in the form of bonds or sell shares. In this environment, in a bear market, we're going into a recession right now. I'm not saying we're going to a recession. There's no maybe. Now, I don't think that we're going to have a deep recession. I'm going to get into it in one moment. But right now, I'm talking about it is very risky, no matter what company it is, to have a growth stock. Because if they're not making money, guess what? They're losing money and they're going to have to raise cash. There's no company that can go 3-4 quarters, multiple years, and lose money. Because when they're losing money, how do they keep the lights on? How do they pay the executives? They have to sell shares or have to borrow and do new loans. So the reason why I don't think this recession will be deep, unemployment is very low. Now on a lot of these companies that we're missing, they're doing layoffs. But still, unemployment rate is at 3.6, And generally, you want unemployment at about 5%. So we have a lot of ways to go in terms of it being a deep recession. A deep recession is when people can't get jobs, companies are doing horrible. In general, companies are still doing good. They're not doing as good, but they're doing good. So unemployment is below 5%, which it is. Companies are still generally beating earnings. Even if gross domestic product drops by 1%, we're not going to have a deep recession unless the Fed decides to raise interest rates to like 4 or 5%. Now, to me, I felt like the Fed is only going to raise to like 2.5 to 3% by the end of the year. And when they raise rates higher, it becomes more and more expensive to raise money. So it's very, very important to see what the Fed's doing. But that's why the Fed is doing it in slow increments. Right now, they're doing 0.5. They're probably going to do another 0.5, 2 straight 0.5s. Maybe they're going to do 3 or 4 0.5s instead of 1.0. Because if they do quick series hikes, it's going to be massive to most of our companies. Most of our companies cannot even support 1% hike. Imagine 2 or 3%. You're going with companies that they're not making money, that have bad financials. You do not want to buy a company with bad financials. If the Fed funds rate, which is about 1% right now, goes to 3, 4%, because it's going to be really, really hard for them to raise money and their business is not making money. So first video, recession. What a recession means to the economy. And believe it or not, everything is connected. Oil, gold, China, Europe, everything is connected. So you got to really see what's going on out there. Even crypto, everything is connected. See what's going on out there. And then, hey, the recession is not going to be good because rates are rising to slow down inflation. And inflation is slowly causing this recession. Energy prices, oil, electric, killing us. So inflation is rising. The only way to combat this is interest rates. So just be careful out there. Just be careful out there.